Hey everybody, it's Pete Carmasino here at Chaikin Analytics. This is the halftime show on StockCharts TV. And each and every week we kind of go over what's going on here in the markets. And last week we talked about Jackson Hole and what the Fed was saying, Chair Powell. And for the most part, we're looking at that bond sell-off continuing, which means rates are moving higher. Not so much today. The bonds did rally a little bit and then stocks sold off. So you're not seeing that nice correlation with stocks and bonds rallying in the same direction, meaning that when bonds move higher, rates should go lower, and lower rates should affect and make stocks feel a little bit better, especially tech stocks. But today we're seeing the Nasdaq off 1%. So I'm doing this after the close today, just to kind of get caught up, from a long weekend here. So just looking at what happened here today in the markets. I mean, look, the Dow is down just about 200 points or so. Nasdaq down about 150. That's over 1%. And the S&P down just around 31 and change. So nothing, monumental here. It wasn't a, massive sell-off or anything of that nature. But I think what the resounding things that people are looking at, the high-level concerns or the focus is really, and it has been energy. And something just really kind of crept up onto my screens this week and over the weekend, which has been restaurant stocks. So today, we're going to look at energy. Specifically, we're going to dive a little bit deeper into there. So I'm going to look at the OIH and the IEO, which are two ETFs for energy, oil, and services. And we'll look at our usual suspects here. We'll look at the S&P, sort of that channel level. We'll look at the Nasdaq as well, just to double check on those two. And I'll certainly look at the oil level, WTIC, and just take a look at, see what's happening there. It's been a big rally, moving above that $85 level, is more psychological than significant. I mean, anything above 75 or higher, it starts to get a little strange. But based on the chart, oil is sort of a continuation trade at this point. So we'll look at some of these things. And I got one thing I pulled up today, and these are relative strength breakdowns. And so I've got a few large names on this chart, or on my screen list, I should say, on this watch list, that maybe are voicing some concerns, and so it's just something to look out for. So let's dive into these charts and see what's going on here today. All right, first chart we're going to look at is the S&P 500 index, and just running this channel back from really the low of October, coming up on a year now, so we're already here in September already. It's amazing. And that low was formed somewhere around or exactly on October 13th. And that was the low print of, let's see exactly what it was. Now that I'm on this, I'm curious. I got a low level of 3491, so just below 3,500 or so, all the way back up to that 4,600 level, and since then just kind of meandering in around here. So I've got a few moving averages on here, just some averages I was playing with. I'm just going to clear this up a little bit. Just look at the 200-day, and then just some areas that I think could, potentially occur. In other words, when I talk about areas, we talk about levels where where the index might start to migrate to. So a couple of key areas are these two gaps here. You see one much lower than the other. The other one here is somewhere around that 4230. Now, as ironic as this may seem, you could see this gap fill right here. And I don't know if it's going to time it into this circle, but I'm going to leave it there and just kind of see how it plays out. That would take a long time. I mean, that would be about a month's worth of trading, 20 some odd days, not including holidays on next holiday we got coming up. And, that could happen. Now, hopefully that holds, or at the worst level, we could see it really getting down to the 200 moving average, 200-day moving average, which is somewhere around that 4170, 4175 level, which we had talked about many moons ago as resistance, and it was absolutely resistance here several times until it broke out. Now, if it gets any further and it goes down to that next gap, and I'm just focusing on the gaps, I just saw these on the chart, so I figured, why don't I point them out? They could be areas of support, and not necessarily have to be, but they're there, so let's look at them. So those are the two spots I'm looking at. The first one being around that 42.35, that's a gap there. The second one being in line with the channel and potentially the 200-day as well, and previous resistance, which is now should be support, 41.72. And the third level somewhere around as low as 4,000, and maybe even as low as just the mid 3,900 level as well. So that would be the worst case that I see. Anything further, we'll just cross that bridge when we come to it. All right, similar look here on the Nasdaq, right? We've got a channel built back from the end of last year or so, where that low was put in somewhere around. Well, the real low was here back in October, just like the S&P, around the 10,400 level. And then, I just built this channel to kind of keep it, coincide with what was going on, right? The levels that were being adhered to are pretty evident. We can see the pullback here around 8.5% or so. And now we're seeing sort of a failure to get back to that high. And it would have been nice to see that Nasdaq push a little higher here. Just depends on what's going to happen with a lot of things here in the markets. And so I do have another gap fill here, unfortunately, and that's about 14% roughly, anywhere between 13.75 to 14.25 roughly on a pullback. And, that could occur. It would break the channel and make that, potentially harder to get back into. But the idea here is that we're just seeing a downtrend here and a sideways action right now, and not really a lot of evidence here to the upside. So just be careful in NASDAQ. We know rates might be moving higher, and tech stocks don't like higher rates and all that good stuff. But there are some stocks that have been performing. So just take it with a grain of salt right now. We'll just wait until we get to these areas when important levels start to be breached. I think then we can start to make some actionable trades here. But right now, it's sort of a no man's land, and we got to kind of have to wait here to see what's happening on the NASDAQ. All right, jumping over here to the dollar. We can see that this is absolutely breaking out of that downward trend. So, on the next chart, I might update that and sort of get rid of that area. Here's that low we talked about, back around the 99 and change. And there's this new channel that's actually forming. And we'll see if it starts to respect this downside level now. But right now, we're just seeing a higher high, a previous high here of 104.25. Now we're handily above that at 104.85. And you're seeing that, this dollar getting pushed around a little bit too much for some people's liking. But watching and seeing that 50-day curling up to the 200, I don't know if a lot of people use moving averages on currency. And again, this is the spot, the cash settle on the dollar. It's not really a currency pair, but we do follow it and track it and understand that it is absolutely going to be impacting many multinational companies as well as other facets of our economy. So it's something you got to be, you have to pay attention to and understand that there is a domino effect when one thing happens here, or on the fixed income side, or on interest rates, whatever the case may be, you start to see other things get affected. It's not sort of, things don't happen in a vacuum. All the instruments are being updated and traded and recalibrated based on the action of other vehicles. So just be careful, watch it, and pay attention to that dollar. We start to see this thing rise. I obviously that's going to coincide with potentially higher rates. Doesn't always have to, but that's what we're seeing right now. And the next thing we're going to look at is oil. Okay, here's oil. We've got light crude continuous contract here. It's an end of day number here, but looking at it and kind of understanding what this is really reflecting. When you see oil start to make these kind of moves, it's just not something that is a comfortable feeling. We don't want to see this rally too high and too aggressively, but unfortunately, that's what we're seeing now. People are playing around with, supply. When you play around with supply, you are really manipulating price. But the idea here is that if supply is dwindling, and believe it or not, our strategic petroleum reserves aren't going to be as effective as they once were because we've just drained them. And we don't have enough to really push oil back around. We just got to, we're going to have to grin and bear it right now. And so it looks like oil closed on 87.66, not much different than it was yesterday. But the point of this is looking at this chart, we are just seeing a new trend develop, and it is up. And so that's going to lead us to looking at some names in that sector, OIH and IEO, two ETFs, and then we'll look at some names inside of those ETFs to see if there's any opportunity there as well. Might be a great pond to be fishing in. All right, as always, we'll look at TLT. I've been talking about this for a very, very long time. My target's still around the 75 to 80. That would absolutely mean rates would be much higher. And look, I do think there was some exogenous events that are occurring, whether it may be Japan or even China. If you look back in June, Reuters had an article out there that said China had reported a 14-year low in ownership of U.S. Treasuries. And now you've got Japan sort of dealing with their yield curve control issues, and obviously their currency is being affected by that. And, rates here will be affected, right? In other words, because if more supply comes on the market of our bonds, you're going to see TLT probably get too much liquidity and start to be, sold off, right? The other side of that is people understand where we are as far as our U.S. debt. People understand that, we're in a situation where the U.S. government is going to be talking about, extending or shutting down or being funded in the next month or so. And so all of that is that rumbling, that riptide of events that starts to sort of, run through the market, and a lot of if-then scenarios start to be played out. And now we are talking about an if-then scenario as well. And so if we start to see pressure on rates, we are going to see bonds on the downside. And that's where I'm coming up with this $75 to $80 target. And I'm coinciding that with, believe it or not, back to the 2008 levels, which would have occurred somewhere on the December timeframe, middle of December 2008, of those high levels. And that high level, unfortunately, wasn't so high compared to where it is today. It's about $82. So I just think if it gets into that range, it's probably going to get through 80 and trade between $75 and $80. Again, that would mean much higher rates from where they are today. I hope I'm wrong. I hope there's an event that occurs that stops that from happening. But at this potential point, I just see that trend occurring, and I don't see that trend changing, not yet anyway. Okay, we talked about OIH now. This is the VanEck oil service ETF, and inside there we've got plenty of names that you would know. Some you may not, but a lot of these names are kind of sitting, in decent setups, right? Here's a name called Drillquip. The stock is really pushing higher. We are bullish on it. Great money flow. The trends are changing. Everything looks very, very positive on this. And I think it's a pretty small company, right? So just be careful when you're using these as any ideas to trade on. And again, these aren't recommendations. We're just kind of looking at what we're seeing here. But a name like NOV, Incorporated Energy and Equipment Service, pays a little bit of a dividend. It's a much bigger company. It trades pretty well. Also forming a very strong pattern, a very interesting pattern, I would say. Again, a trend change in the making. But going back to OIH, here's something we were talking about right around this level where it changed at around 310 to 320, and it has pushed to new one-year highs. But I was on the 5-year chart when I started this video and looking at where it could potentially end up, which maybe we start to see 377, 380 or so, maybe even 400 on this. And what's going to propel that is obviously the names inside of here. So you want to look at some larger names, some names that, might be more, able to kind of weather any kind of volatility. But you're seeing names like Halliburton, you're seeing names like Schlumberger. All of these are changing trend. And they look, very, very interesting. I've never heard of this company. I don't know what exactly size it is, but it's a $7 billion company. It's called ChampionX. Interesting name. But, I see the chart pattern is very, very similar. We know Valaris here, another great chart pattern. We talked about that one already. Let's look at TS here, Tenaris. A very similar chart pattern, just not as convincing. So a lot of the same relative strength changes happening inside here. And then we'll look at IEO, another oil and gas exploration ETF. And what's the cool system we have here? I can click on the symbol and get all the symbols that are inside of here. So you'll see some refiners in here like Valero, very similar pattern, not quite there yet. We'll look at Chesapeake, starting to change, right? These names are happening. Here's PSX, starting to change. A change occurred just a while ago. So I'm seeing the same thing I'm seeing on ETFs here, which obviously we see a relative strength change to the upside, and really kind of pushing the envelope, obviously because of the energy prices, right? When energy starts to move, these stocks start to move as well. And IEO is really at about a 5-year high. I don't know what its all-time high is. Our charts don't go back that far, but that can still, give you a level of 106 to 110 if the trend continues and stays strong. So just another area to kind of consider. All right, we said we were talking about energy, and then the next one was an area that we were going to talk about was going to be restaurants. And I'll start off with the fast food giant here, McDonald's, worldwide company, absolutely. Putting in new levels here. Now, I thought this 280 was going to be supported, had held a couple of times. You saw some previous pushes higher here that failed. And then once it broke out around that 275 to 280 level, it pushed higher. Now, it held on these tests around 280, back in June and just recently here in the end of August, but has broken down. The relative strength was weak since June. We've known that, but the money flow is catching up with this. The industry itself is weak as well. So McDonald's, one of the names that kind of popped up on my radar as well. Let's look at another one, Shake Shack, that everyone's favorite name. Now, not down today, up about 0.5%, but a similar pattern is forming here. Not as prominent as McDonald's, not yet anyway, but getting into that area right here. This area looked like support, and it's really testing it. So it definitely held so far, but that relative strength is about to break down. It's something I would just keep on the radar if you got exposure to it. Let's look at another one here, BJ's restaurants, BJRI, a very similar pattern, even worse than McDonald's. Been on a negative relative strength since March, really hasn't done much sideways action here, but I think if it gets below that 27 and a half, you've got bigger problems as well. Let's look at Brinker, EAT, Brinker International. Again, another similar breakdown here from June, breaking new lows. I should say recent lows, not 52-week lows, but on the target is around 23. That's not that far. Really, it's about 7 points. So just got to be careful on Brinker International here. And the last one we'll look at is Jack in the Box, JCK. Another one here. Now, this is neutral plus. That means it's a bullish stock, right? Good fundamentals, but the technicals are getting weak. So, look, we know that good stocks can go down, and markets can ignore fundamentals, good or bad, right? They can ignore the bad ones and run stocks all the way up, and they can ignore the good ones and push them all the way down. And so we're seeing that here in Jack in the Box. Good fundamentals, but really on support. Look at this. I mean, you can't, this is no denying that it's around $78. It bounced off of there today, but still closed down about 1.7%. The worst part about this chart is the relative strength change and the negative money flow, all confirming that break below the long-term trend. And obviously the industry itself is weakening. So just be careful with these names if you have them in your portfolio. All right, I said we were going to look at some negative relative strength changes. And the first one that really surprised me was Ferrari here, symbol RACE. The stock's been, on a tear this year, but overall, even since its IPO, it's been done nothing but race higher. Sorry, pun intended. But I really haven't seen a breakdown in this name for quite some time. And this is just beginning. Again, negative money flow. The trends with the industry strong. Automobiles are kind of hanging in there, but I don't like this level here that's starting to break recent lows. I would just pay attention to this. Just, again, something that's popping up on my radar that doesn't look fantastic. Here's a building products company in this list as well, Masonite International. They run, they distribute and manufacture interior and exterior doors. And so you're just seeing, look at this. It looked like a bull flag here, but we really had negative money flow. Excellent relative strength, has been doing very well, but it is starting to weaken here. Just a name that's just kind of popping under that trend. Just be careful with it. Earnings are coming out in 2 months or so. But again, I would just, something that's popping up on my radar here as changing trend to the downside. Here's another one, Marine Products, leisure product company. Obviously, they sell boats, power boats, sport boats. And you're seeing a level here breaking that look like, again, let's see that cup and handle for me. You got to really squint to see it. But I would think that $14 level was pretty interesting, and it broke it today at $13.75. Looked like it should have been support, didn't hold, and I'm getting negative money flow, but a negative relative strength change. Just don't like it, and I'm just calling it out because it landed on our list here today. All right, everybody. Thanks again for tuning in on this week's halftime show. Again, follow me on Twitter. Just below here in the YouTube section, you can see my link at Carmasino on Twitter, or X as it's now known, formerly known as Twitter, I suppose. And, we do a lot of things out there. I'm doing a lot more activity, putting out more charts and just talking about what's going on in general markets, getting into more discussions and things of that nature. So follow me on Twitter, but also give me a like here. And if you have any comments you want to put below the video, I really appreciate that as well. Take care. We'll see you next week.